Thank you for joining me today. This presentation is going to walk you through a product called Bridge from Equitrust. If you've never heard of Bridge before, that's exactly who this presentation is for. We're going to start at the very beginning and discuss what the product actually is in plain English, and then build from there. We will cover the market opportunity behind it. I will show you exactly how the mechanics work. I will use a real client example using actual illustrated numbers. And finally, at the end of the presentation, we will look at the kinds of clients in your book you should be picking up the phone and calling. By the end of this, my goal is that you've already got 2 or 3 names in your head of people you want to call. We're always here to support you every step of the way. Always give me a call to discuss any potential clients. We can't wait to help you get your first sale. So let's start with the simplest possible explanation of what this thing is. Bridge is a fixed index annuity. If you've sold an FIA before, the chassis underneath this is going to feel familiar. Client puts in single premium. That money gets allocated to index-linked accounts, and it has the potential to grow based on market index performance. Index credits are never less than 0. So a down market year doesn't subtract from the accumulation value the way a direct market investment would. Now I want to be precise about something here because it trips agents up. A 0% index credit doesn't mean the accumulation value stays flat. Rider charges. The long-term care rider charge and small never stop wellness fee still come out every year regardless of index performance. So in a year where the index credit is 0, the accumulation value can actually tick down slightly, purely from those charges. We'll look at that directly in Peter's real illustration later, so you can see exactly what that looks like in dollars. The protection here is against market losses, not against every single fee ever reducing the balance. But built right into the same contract on the same application is a long-term care rider. And here's the part that makes this product different from almost anything else out there. That LTC rider comes with guaranteed approval. Your client doesn't have to qualify medically to get long-term care coverage. So in one sentence, Bridge gives your client growth potential on one side and a guaranteed tax-free long-term care benefit on the other side from a single application. That's it. Everything else we talked about today is just filling in the details behind that one idea. Let's run through what actually makes this product different, because none of these things on their own are revolutionary. It's the combination that's unique. It's built on a standard FIA chassis, so the growth mechanics are nothing exotic. Premiums are flexible. But then look at the next one, simplified underwriting with guaranteed approval for long-term care benefits. I want you to sit with that for a second, because if you've ever sold traditional long-term care insurance, you know how big of a deal this is. No more losing a sale to a decline letter after weeks of paperwork, exams, the entire process. Then there's the Never Stop, which is a wellness program. We'll spend a whole slide on that later because it's worth understanding in depth. There's an indemnity claim process, meaning when your client has a covered need, the benefit pays out without them having to submit receipts for every expense. And there's a custom LTC benefit. I like to call this one size fits none, meaning the benefit is actually sized for each individual client through the underwriting process, not a flat number everyone gets. Last two, a charge structure that's meaningfully lower than competing products. We'll look at real numbers on that later. And a completely digital process, start to finish. Let's keep building from here. Here's a question for you. Think about the last client you had who wanted long-term care coverage, but didn't want to deal with a long medical questionnaire or worried they might get declined. That's exactly who this slide is for. With Bridge, there are no health questions in the traditional sense, no medical exams, nothing that looks like classic underwriting. No prescription database checks, no phone interview, and no field underwriting visit to the home. I want to be really clear about what guaranteed approval actually means here, because it's easy to misread this. It doesn't mean every client gets the same benefit amount. It means every client who passes basic annuity suitability gets covered for long-term care, period. What underwriting determines is which rate class they land in, and we'll cover exactly how that works in a couple of slides, but nobody walks away with a decline letter. Before we go further into the product, let's talk about why this conversation matters right now. There are fewer than 15 carriers left selling standalone long-term care insurance. That market has been shrinking for years. Carriers have been pulling out, raising premiums, or both. Family caregivers are absorbing about 26% of the personal income on caregiving expenses when they step in to help a parent or spouse. And 88% of adults between 50 and 80 say they want to age in place, not in a facility, which takes real planning and real money. Now look at traditional LTC insurance. A couple at age 55 is paying around $5,000 a year in premium. And here's the part that always gets a reaction in the room. If they never use it, the residual value of that policy is zero. They paid in for years and get nothing back. On the right, the actual cost of care, if they do need it, over $9,000 a month for a semi-private nursing home room, just under $6,000 for assisted living, and around $6,500 for home health aid. So that's the dilemma. Care is expensive. Traditional insurance to cover it is shrinking and expensive. And if you never use what you bought, you get nothing back. Keep that last point in your head because it's exactly what Bridge solves. Okay, here's the full spec sheet. Issue ages 50 to 80. Minimum premium is $50,000. And right now that has to be non-qualified money. So not coming directly from an IRA or 401k. Premium is flexible, meaning a client isn't locked in to a single deposit forever, though most cases we see are single premium. There's a 10-year surrender charge schedule, and 10% of the accumulation value can be withdrawn free of charge each year after the first year. On the growth side, there's accumulation value potential through 5 different index accounts plus a fixed account, a flexible benefit base we'll get into in detail. And built into all of that, the long-term care rider with guaranteed approval, plus the Never Stop Wellness program. Now, instead of talking through this in the abstract, I want to introduce you to an actual case. This is Peter, a real 55-year-old client who put in $100,000 of non-qualified money. He went through the underwriting and came back preferred class, which gives him a 325% coverage ratio. We're going to use Peter's exact numbers for the rest of this presentation. So by the end, you'll have seen every single mechanic of this product applied to one real, traceable example, not a marketing illustration. So how does underwriting actually work mechanically? It's a single online interview, about 30 minutes, run through Equitrust underwriting partner, Assured Allies. Underwriting is entirely optional. If a client opts out, they're automatically placed in the secure underwriting class. Still covered, just the most conservative coverage ratio. If the client goes through it, there are 5 health questions asked of every applicant. Things like whether they currently need help with daily activities, use mobility equipment, or have certain serious medical diagnoses in the past 5 years. If they answer yes to one of the first 3 of those 5, they're placed in secure. Otherwise, the interview continues with identity verification using a government-issued photo ID, and then a cognitive screen that checks recallability, plus a physical screening for balance and muscle strength. That's genuinely it. No blood draws, no pharmacy database pull, no in-home nurse visit, no medical records requested. For our example client Peter, he went through this process and came back preferred, the best class available, which is why his coverage ratio is 325% at age 55. That's the maximum for his age and class. We'll see exactly what that number means in just a moment. This table is the single most important mechanic to understand in the whole product. So let's slow down here. The coverage ratio is the multiplier that turns a client's premium into their starting LTC benefit base. and applies to all premium received in the first 5 contract years. Look at how it changes by underwriting class and age. Secure class starts at 150% at age 55 and steps down slightly with age. Standard is 225% at age 55, and preferred, the best class, is 325% at age 55. I want you to notice 2 things. First, younger issue age gets a higher ratio across every class. So there's a real incentive to have this conversation with clients sooner rather than later. Second, the gap between secure and preferred is enormous, more than double. That's the financial impact of going through that quick underwriting interview instead of skipping it. Now let's apply this to Peter. He's 55, preferred class with $100,000 premium. 100,000 times 325% equals $325,000. That's his initial LTC benefit base. The starting point of how much long-term care coverage he has, which is already more than 3 times what he's put in. This is a slide I think gets skipped over too often, but it's an important detail to understand and to be upfront with the clients about: the vesting schedule. When a bridge policy is issued, the client doesn't have full access to 100% of the benefit base on day 1. It vests over the first 4 years. 20% in year 1, 40% in year 2, 60% in year 3, 80% in year 4, and fully vested at 100% starting in year 5. Why does it work this way? Well, it protects against someone buying the policy and immediately filing a large claim before they've really been a policyholder. It's a standard reasonable safeguard you'll see in some form across this category of product. For Peter, here's what that looks like in dollars. In year 1, his vested benefit base is about $146,000. That's the guaranteed value. By year 2, it's roughly $197,000. Year 3, $252,000. Year 4, $312,000. And from year 5 onward, he has the full guaranteed access to the entire benefit base, which itself keeps growing every year from the roll-up we'll talk about shortly. The headline point to give a client: even in year 1, before anything has fully vested, there's already meaningful coverage in place. This isn't a cliff, it's a ramp. This slide is where it really clicks for most agents, so let's go column by column. I've added the actual monthly LTC benefit figures here too, both guaranteed and with wellness credits included. So you can see exactly what these numbers mean if Peter ever needed to file a claim at each point in time. At issue age 55, Peter puts in $100,000. His coverage ratio of 325% gives him an initial benefit base of $325,000. If he needed a claim in year 1, his guaranteed monthly benefit would be $2,434, or $2,553 including the wellness credits. Meanwhile, his accumulation value, the actual cash value in the contract, starts at $100,000 and on a non-guaranteed basis using the current illustrated index rate grows to about $107,796 by the end of year 1. Jump to year 5 when he's fully vested. His benefit base from the 3% roll-up alone is now $376,764, and with the wellness credits, $388,485. His guaranteed monthly benefit at that point is $6,279, or $6,475 with the wellness. His accumulation value has grown to about $139,000. By year 10, age 65, monthly benefit is up to $7,280 guaranteed, or $7,815 with the wellness. Accumulation value sits around $195,000. And by year 20, age 75, his guaranteed monthly benefit reaches $9,783, or $11,038 on a non-guaranteed basis with the maximum wellness credits. Meanwhile, his accumulation value has grown to $375,000, $279,195. The key thing I want you to take away from this slide, there are two completely separate pools of money here, both growing from the same single premium and the same single application. One is spendable cash value, the other is a monthly long-term care benefit that gets stronger every single year. Neither one limits the other. This chart is the picture I want you to be able to draw from memory in a client meeting. On a whiteboard, on a napkin, it doesn't matter. It's the single most persuasive visual in this whole presentation. On the left, the accumulation value bar, the dark teal block at the bottom is Peter's $100,000 premium. The gray block on the top is 20 years of index credits on a non-guaranteed basis using the currently illustrated rate. Together, that's $379,195. That's spendable money. His use for anything, or it becomes a death benefit for his beneficiaries if he never needs care. On the right, the LTC benefit base bar, and this is a completely separate pool of money. The light blue block at the bottom is his initial benefit base from the coverage ratio, $325,000, which is also his vesting period. The lime green block is 3% annual roll-up, taking that base from $325,000 up to $586,986, guaranteed. And the dark teal block on the top is the maximum wellness credits he can earn through the Never Stop participation. $75,283. Add it all up, $662,270 in a long-term care coverage. Say this part slowly to a client. This benefit base is nearly double his accumulation value. If he needs care, the left bar is what he or his family gets. If he does not need care, the right bar, almost twice as much, is what pays out tax-free for up to 60 months. Same premium, same application. Two completely different outcomes depending on what life brings. Let's spend real time on Never Stop because I find agents tend to mention it as an afterthought when it's actually a meaningful piece of the value proposition. Never Stop is a wellness program built in partnership with Assured Allies, running on data, technology, and the science of aging. In practice, that means your client gets a personalized wellness plan, a real dedicated health coach, not just an app, who provides guidance and accountability, a set of recommended daily actions that are actually proven to support independent living, and an online member site to track all of it. Here's the part that matters financially. This isn't just a feel-good add-on. Active participation earns wellness credits, and those credits get added directly to the LTC benefit base every 2 years for up to 20 years. The maximum credit available varies by risk class, and if a client only participates partially, they earn partial credits. It's not all or nothing. And the cost to the client for all of this, just $100 a year, deducted automatically from the accumulation value. Enrollment happens automatically when the policy is issued. One thing to flag, this program currently isn't available in Massachusetts, Maryland, Oregon, or Virginia. And in Montana, there's no annual fee. It's worth checking your client's state. For Peter, if he fully participates over 20 years, that program adds $75,283 to his benefit base, on top of the 3% roll-up we already talked about, for a total cost of just $100 a year. When you're talking to a client, frame this as a genuine win-win. Never Stop is designed to help them actually stay healthier, more independent longer, and the program rewards them financially for engaging with it. If you've never sold an indemnity-style long-term care product before, this next product is worth understanding clearly, because it's genuinely different from how a lot of agents think claims work. Step 1, benefit qualification. Specifically, the client needs to be unable to perform 2 of 6 activities of daily living on their own. Things like bathing, dressing, eating, walking, transferring, or toileting, or have a qualifying cognitive impairment confirmed by a physician's plan of care. Step 2, filing the claim. And here's the key word, indemnity. That means this is not a reimbursement product where your client has to submit a stack of receipts every month to get paid back. The benefit amount is set at the time of the claim, based on the benefit base. Step 3, the monthly benefit begins, paid out for up to 60 months, income tax free under Internal Revenue Code Section 7702B. One detail worth knowing precisely, those payments reduce the accumulation value dollar for dollar as they're paid. But critically, the benefit payments keep going even after the accumulation value hits zero, as long as the client hasn't taken separate withdrawals outside of the claim. Step 4, there's periodic physician recertification to confirm the client still qualifies, and if their client needs are intermittent. Say they recover partially and they don't need ongoing care for a while, the benefit can pause and restart. That helps preserve value if the need isn't constant. For Peter specifically, at year 20, if he needs to file a claim, his guaranteed monthly benefit is $9,783, or up to $11,038 on a non-guaranteed basis if he's earned the maximum wellness credits. Either way, that's paid monthly, tax-free, for up to 5 years. Now I want to highlight what I think is the single best sales angle for this product that most agents are overlooking: tax-free long-term care benefits, especially for clients sitting on a non-qualified annuity with deferred gains. This isn't a hypothetical I came up with. This is Equitrust's own published example, and it's compelling enough that I'd rather just use their numbers directly. Picture a 50-year-old client, preferred underwriting class, who has a $100,000 non-qualified annuity with $50,000 of taxable gain sitting in it. Without doing anything, if the client needs long-term care and pulls money out of that taxable annuity at a 22% tax rate, they owe $11,000 in taxes, leaving them only about $89,000 actually available to pay for care. Now, instead, if they do a 1035 exchange of that same $100,000 annuity into the bridge at preferred class with the coverage ratio applied, they get immediate access to more than $330,000 of tax-free long-term care benefit base. That's a 271% increase in available dollars for care, completely tax-free under Section 7702, compared to just spending down the original annuity and paying the tax. This is also a great way to think about Peter's case. His benefit-based income, when he eventually claims, comes to him completely tax-free. No 1099, no gross up, no bumping into a higher bracket. Here's how I'd suggest opening this conversation. Ask a client directly, do you have an older annuity or life insurance policy you're not really using anymore? If the answer is yes, that's your 1035 exchange conversation right there. This is also a great topic to bring up alongside a client's CPA or estate attorney. Let's talk about costs, because agents who have sold hybrid LTC products before are going to ask about fees. You should have this chart in your back pocket. I want to flag that I'm using Equitrust's own published comparison here, and they anonymize the named competitors as Carrier A and Carrier B in their official materials, so that's how I'm presenting it as well. This compares annualized charges as a percentage of accumulation value after 10 years on a $100,000 premium, issue age 65, at the maximum available coverage, preferred underwriting class. The first named LTC annuity hybrid carrier runs about 2.44%. The second runs about 1.57%. Bridge from Equitrust runs about 0.51%, roughly 4 to 5 times more efficient than their competitor. Why is Bridge so much cheaper? Well, it comes down to how the charge is calculated. Bridge bases its LTC rider charge on the net account at risk, the difference between the benefit base and the accumulation value, rather than charging against the full accumulation value the way some competitors do. As those two numbers converge over time, the charge basis actually shrinks. This is a structural design choice, not a temporary promotional rate, so you can talk about it with confidence as a durable advantage. This chart takes the fee comparison one step further by showing what the client actually nets after fees. Lower fees translate directly into a meaningfully higher net rate. The first named competitor nets about 1.06% after its 2.44% charge. The second nets about 3.93% after its 1.57% charge. And the bridge, that's 6.34% after only a 0.51% charge. This is the number that matters most when a client is comparing illustrations side by side. Not just what's the fee, but what do I actually keep? Bridge wins clearly on that question. Fair question you'll get from agents and clients alike. Okay, preferred sounds great, but what if my client lands in the lowest class secure? Even secure class, the most conservative tier, the one assigned automatically if a client skips underwriting entirely, still runs only a 0.28% annualized charge with a net rate of 6.57%. Compare that to the two named competitor products in Equitrust owned materials, which don't even offer an equivalent no underwriting tier at all. So the honest comparison for a client who can't or won't go through underwriting isn't secure class bridge versus preferred class competitor. It's secure class bridge versus no coverage at all, because those competitor products require underwriting just to get covered in the first place. Even the floor on this product beats having nothing. Let's get practical. Where does the money for a bridge premium actually come from? Three common sources. A 1035 exchange of a non-qualified annuity that has deferred gains the client hasn't been using. This is exactly like the example we just walked through. A 1035 exchange of life insurance cash value that's no longer needed. Think clients whose kids are grown and mortgage is paid off, where the original reasons for the life insurance policy isn't there anymore. Or just plain old checking, savings, money market, or CD funds sitting idle, often earning next to nothing in interest. One important caveat to remember right now, Bridge only accepts non-qualified money. IRA and 401k dollars don't currently qualify for funding this product. This slide is really the bridge, no pun intended, between this sounds great and okay, where do I actually get the client's premium from? Let's go through a few objections you're likely to hear so you're not caught off guard. What if I don't get preferred? Set this expectation before underwriting even happens, not after. Most clients land preferred or standard, but even secure class coverage beats self-funding a care event entirely or having no LTC coverage at all. Second, the $50,000 minimum is a lot of cash. That's fair, and it's not non-qualified money only today. This is exactly where you point back to the funding sources slide. Old annuities, unused life insurance, cash value, idle savings. Third, what if I never need long-term care? This is a big one, and it's an easy answer. Unlike traditional LTC insurance, this isn't use it or lose it. The accumulation value keeps growing the whole time, and if care is never needed, it becomes a death benefit for their family. And fourth, I already have long-term care insurance. Don't assume that ends the conversation. Ask when they were last quoted. A lot of older LTC policies have seen steep premium increases, and the carrier pool has shrunk a lot. It's genuinely worth a second look. The common thread across all of these, have the answer ready before objections land. That's what makes you sound confident instead of like you're backpedaling. This is, in my opinion, the most important slide in the whole presentation, so I want you to actually do this with me right now, not just listen. 5 types of clients you most certainly already have in your book. Number 1, the decline client. Anyone you've worked with who got turned down for traditional long-term care insurance the last few years. Guaranteed approval on the bridge ends that conversation for good. Go back to those people. Number two, the high tax bracket client, the ones already comfortable financially, where the tax-free nature of this benefit is the real selling point, not affordability. Number three, the idle cash client, anyone with money parked in CDs, savings, or money market accounts that isn't really working for them. Number four, the old policy client, someone with cash value life insurance they bought years ago for a reason that no longer applies. Kids are growing, mortgages paid off. That's a clean 1035 exchange conversation. And number five, the aging in place client, anyone who's ever told you they want to stay in their own home as they get older, not move into a facility. Here's your homework before we move to the next slide. Think of one actual name for each of these five categories. I'll give you a second to write them down. All right, let's wrap it up. Today we've covered everything from bridge basics and market opportunity to underwriting, growth mechanics, fees, and objections. If you take away nothing else, take away those five names you wrote down earlier. That isn't theoretical. That is your call list for this week. For product mechanics and paperwork, reach out to Equitrust support line on the screen. But for case strategy, positioning, or building out real illustrations, call me directly. I want to help you build your first few bridge cases so you don't have to guess through it alone. I can't wait to help you get your first bridge sale. Thank you very much.